Episode 6, Understanding Bonds, What They Are and How They Work. In this episode, we'll dive into bonds, a popular type of fixed-income investment. We'll explain how they work, why investors use them, and how to assess their risks and rewards. What are bonds? A bond is essentially a loan that an investor gives to a government, corporation, or other entity. In exchange, the issuer agrees to pay back the principal amount, face value, at a future date, the maturity date, along with periodic interest payments, coupons. Bonds are often considered safer than stocks because they typically offer fixed returns. Types of bonds. Government bonds, issued by national governments, e.g., U.S. Treasury bonds. These are typically very low risk because they are backed by the government. Corporate bonds, issued by companies to raise capital. These bonds usually offer higher returns but come with higher risk. Municipal bonds, issued by state or local governments. They are often tax-exempt, making them attractive to certain investors. High-yield bonds, also known as junk bonds. These are issued by companies with lower credit ratings. They offer higher interest rates to compensate for the increased risk. Bond pricing. Bond prices fluctuate based on interest rates and the issuer's creditworthiness. When interest rates rise, bond prices generally fall, and vice versa. Yield. The yield on a bond is a return an investor can expect to earn if the bond is held to maturity. It's influenced by the bond's coupon rate, price, and time to maturity. Risk factors in bond investing. Interest rate risk. When interest rates rise, the price of existing bonds typically falls. Bonds with longer maturities are more sensitive to interest rate changes. Credit risk. The risk that the issuer may default on its bond payments. Investors should assess the issuer's credit rating before purchasing bonds. Inflation risk. Inflation can erode the purchasing power of bond payments, particularly for long-term bonds. Call risk. Some bonds are callable, meaning the issuer can redeem the bond before maturity date, usually when interest rates fall. This can limit the bondholder's return. Bond ratings. Bond ratings are provided by agencies like Moody's and S&P to assess the likelihood that the issuer will repay its debt. Bonds with higher ratings, e.g. AAA, are safer but offer lower yields, while lower-rated bonds, e.g. BBB junk bonds, are riskier but offer higher yields. Why invest in bonds? Bonds can be a great way to diversify your portfolio and add stability, particularly for conservative investors. They provide steady income and are generally less volatile than stocks. Bonds also help balance portfolios during stock market volatility, especially government bonds, which tend to perform well during times of economic uncertainty. Thank you for watching. Please like and subscribe for more money tips.